All right, boys, trading for dummies, episode whatever. We're doing indicators. I suggest you don't use indicators, but if you do want to use some indicators, here's the trick. You'll see a different background behind me. We're currently traveling through Spain, so thus the shorts and the sunny weather outside that you cannot see. But hopefully if you use indicators correctly, which I advise you do not, maybe you can travel through Spain pretty quick too. Trading from the laptop is absolutely wonderful, so hopefully I can help you guys get to the same sort of points. And once you do get profitable, once you do get a couple prop firms under your belt, you're going to be able to get some payouts and then kind of snowball it from there. And you can go to cheaper places to live, and it's kind of nice because you can travel around and all that jazz. So enough banter. Next few episodes here are probably going to be in different places while traveling Europe. Let's jump into TradingView. All right, so we're going to jump to the S&P, similar to the NASDAQ. We're going to delete all these lines. So you're going to notice, first of all, I have a couple indicators already on the chart. This is something called Polytrends. It's by my buddy. It is a paid indicator, super expensive, and I don't really advise you use it until you get profitable because it is super expensive per month, right? All it does literally is draw lines for me that makes it easier to trade my strategy, which is dumb money concepts, right? And that's just basically the horizontal levels that allow me to quicker see those levels, right? Generally, all of the best indicators are going to be things that just make things a little bit easier for you, right? So if I jump down to 15-minute here, I also have something called sessions, right? Which makes it a little bit easier to see what time it is, okay? So this is the London session, this is the New York session, this is the Asia session, and then those are the overlap sort of nothing sessions, right? Just to kind of make it easier to see, but you don't need them. Honestly, you don't need them. Let's jump into like the most common ones that people may or may not use here. Moving average, right? There's various different moving averages. Use moving average, MA cross, moving average cross. So that's going to be two moving averages. If you double click on these, you can jump into two different lengths, right? And all the moving averages is the average price of the previous 9 or 21 candles, right? And then generally how people use these is when it crosses, it tells you that the price is moving in the other direction. These are great to determine longer term trend bias on higher time frames if you don't understand trend too well. So that's why I'm advising you on this. What I would do with the moving averages is say, hey, pick any sort of moving average, maybe a 21 or something like that. You can get rid of the 9 maybe, right? Or you can use a cross. There's EMA also, which is exponential. Exponential meaning that the most recent price is weighted stronger. So if you change this around and say like 50 or something like that, you're going to see a slightly different chart here, right? And the 51 is going to be a bit bigger. So if you want a higher number, basically all that's going to mean is the trend will linger for longer in the current trend, right? So in this sort of example, you can see, okay, price is above the moving averages, right? And most likely you could then drop down the time frame and try to scalp within that trend. I wouldn't advise using the moving average with only one time frame. So what I would probably do is say, hey, if you want to determine the bias of what direction you're going to go, maybe jump on the multiple hours or something and say, hey, looks like the price is above the moving averages here, right? And we have that cross to the bullish side. So we probably want to be looking for buys. And then we would go drop down the lower time frame. And just because this has gone to the other side does not necessarily mean it's a sell anymore. The higher time frame is still positive. So you probably will be wanting to look for buys as it came back against this moving average, which this might actually be a perfect time to buy and then continue that trend. Another key one people like to use is Fibonacci. I'm not going to explain Fibonacci too much in here. Fibonacci is a tool that you can use to drag and you can kind of see retracements. I just use it to use the distance of how far my profit went, but usually people use it as a retracement tool simply to see, okay, how deep does it go back in a retracement, and then they usually buy like a 50% retracement, something along those lines. The major key ones, of course, are horizontal levels, which they often retest the highs and lows of pivot points, but that's not really an indicator. There are some interesting things here like stop hunt that you can look for. Things like this. Stop hunt is basically just an indicator whenever you have these massive wicks, something that's somewhat useful. Those massive wicks will then tell you where it's gone behind a level and then close back within, which I think is really good for helping you see things once again, but it depends on how those stop hunts are being drawn. So you might not want to use that because it might not be drawing correctly, and you don't want to be trusting an indicator be giving you information that might not be accurate. Another common one of that sort of manner might be FVG. Sam, once again, FVGs are these gap area. If you are an ICT sort of trader, there's lots of indicators like this that, again, make things easier to see, but you do not need them because they basically just draw something you can already see on the chart with highlighted levels. Now, there's lots of other ones here you can see in the strategies. There's MACD, which is an oscillator. Don't suggest it, pretty bad. Again, they're just kind of trending oscillators. Bollinger Bands is kind of a bouncing thing. This, I have no idea what it is actually. Let's scrap that out because it looks like some sort of weird strategy thing. So Bollinger Bands, another one people commonly use that just basically shows you a range, completely worthless. I'm going to tell you that right now. Pretty much all indicators that do something like special are pretty much worthless. So when looking at indicators, you basically have a couple of different classifications of what they can do. They can either identify things so that it's easier for you to see. This might be drawing levels, might be drawing FVGs, it might be drawing sessions, it might be drawing wicks, okay? Those are all great. Those are the ones you would want to be using. The other option is trend-based indicators, lagging moving averages, MACD, stochastic RSI or RSI. These things show you the trend over time and oscillate depending on how the price moves over a longer period of time. They're great in order to determine the general trend that you don't make instinctive reactions off of impulse moves. The next thing is these special sort of quirky indicators like Bollinger Bands or Fibonacci or Elliott Wave or the parabolic SAR. A lot of these things are really, really niche, and I don't suggest you dive into any sort of thing like that because they're super, super unique. They might be used for some people. As a newer trader, don't try to catch on to these special indicators because they're basically just trying to sell you the dream, and they don't do anything other than one specific, very, very specific thing that does not help you trade unless you're using it for something very specific. And the final thing that are indicators are kind of just like levels and lines that you can draw. So trend lines, arrays, horizontal levels, all of this jazz. Any sort of just line that's going to help you determine where support may lie, right? So that might have to do with support and resistance. That might have to do with gaining and losing levels. That might have to do with stop hunts or failing to gain, all of this jazz, SR flips, breakouts, all of that jazz. They could be there once again to kind of just draw levels for you to make things a little bit easier. That kind of falls into the first classification. Anyways, guys, that's the whole lesson. See you guys in the next one.